Hi everyone, Andrew here again. I was asked the other day, what is the most appropriate stock to bond allocation for someone in their 50s in their pension fund? And just for clarity, when someone's talking about stocks, they're meaning shares, equities. So really the question is, how much risk should someone be taking in their pension fund? And of course, there's no absolutely perfect answer. Like a lot of these questions, it will always depend, but there's some really important things to think about and to consider if you've got a similar question yourself. The first question to think about is the time frame. How long is it before you intend to access the pension fund and retire? Because the longer the time frame, the more risk you can afford to take, and risk within investment and the investment world means more allocation to equities, because you can afford the short-term dips that equity markets go through to get the long-term returns. So that's a really key point. You also want to think then about what's the actual intention for the pension fund. Is it that you intend to use the whole fund to purchase an annuity, which is a guaranteed income for life, which once you do, you can't revert, so you're committing the capital? Or are you going to go into income drawdown and keep the fund invested and draw down from it? Now, I have done another video on the difference between annuities and drawdown, so do look out for that one if you want more of an explanation. But for the purpose of this answer, if you expect to give up the fund to purchase an income, then you don't want the fund to be falling in the period before you purchase an annuity, because you won't be able to get it back again. So that will mean less income for life. So there you might be taking less risk. But if you're going to keep it invested in drawdown and have a much longer investment time frame, you can afford to have more risk and that higher allocation to stock markets, to equities. Another really important consideration is the size of the pension fund relative to the income you need to draw from it if you're staying in drawdown. The bigger the ratio of income need to pension fund, the less risk you could afford to take, because what you don't want to do is see you pulling out money in income at the same time that the fund is falling because the stock markets have fallen, meaning you're eroding the value of that capital really quickly. So a bigger pension fund can support a more sustainable income. There's been a lot of studies around what's a sustainable level. Anything between, say, 3.5% to 4% per annum withdrawal rate is deemed to be more sustainable. But again, that's not a perfect world either. Other aspects to think about: what other resources will you have, financial resources in retirement? Have you got other guaranteed income sources? So state pension being the obvious one. You might have a defined benefit pension income. Spouses might have money coming in. You might have investment income, rental property income. You might continue to work for a little bit, maybe part-time. So the less you have to draw from a pension fund, the more risk and allocation to equities you can take. There's also different degrees of risk to think about as well when we talk about investing. There's your psychological risk profile. That's really your willingness to take how averse or speculative naturally as a person, and the more risk averse, the more you might have in lower risk government bonds. You want to think as well about what the FCA refer to as your capacity for loss, and that links back to what I was saying about how much income you need to draw down. Capacity for loss is how much short-term losses you can afford to suffer within a pension due to stock market crashes without having a material effect on your lifestyle, particularly meeting your essential living costs. So the higher capacity for loss you have, the less reliant you are on a pension fund and the more risk you're able to take. And then there's your need to take investment risk as well. If you're investing for the long term, you can argue that you can have more in equities because you can suffer those falls. So your willingness to take risk, your need to take risk, and your capacity for loss, three really important measures of risk, as well as your time frame. So that really covers it. So there is no, as I said at the start, no perfect answer. If you're looking for a rule of thumb and you're intending to go into drawdown, I would say probably anything less than 40% in equities, so 60% in bonds, you're starting probably not to get enough degree of risk for investment returns to match income withdrawals and beat inflation as well. Anything more than maybe 70% in equities and 30% in bonds, and you're getting possibly to have more volatility than you might be comfortable with, and maybe impacting your capacity for loss during times of market turmoil. Of course, there might be situations where it's suitable to have different allocations out, less than 40% in equities and more than 70% in equities. It really is down to you, and it's an important thing to get advice on. But hopefully, if you are pondering that question about what's the best allocation between stocks and bonds, that's been a helpful review for you. If you've got any questions, let me know in the comment section or just get in touch.